This past year, there were over 5 trillion Google searches. That's 13.7 billion searches every single day. Google Search has more daily queries than human beings on Earth. Google has become the portal to the internet through which most people discover websites, browse the web, shop, and find answers to their questions. It's a verb. You Google it. It's basically a meme at this point. This has powered one of the most profitable businesses of all time via digital advertising. When you search on Google, there are sponsored links from advertisers that bid to get shown for that keyword. Legendary investors like Warren Buffett have described it as one of the best business models due to it having practically no incremental cost. The business is so good that Buffett says he should have recognized it earlier on.
Another stock that you mentioned over the weekend saying you should have known it early on was Google, Alphabet, the parent company of Google, because you knew how much they could charge you when it came to Geico.
Yeah, here we were at Geico paying them $10 or something for every click. I mean, $10, and no cost of goods sold. I mean, and it produced results for us. That's why we paid them the money. So I had seen the product work. And I knew the kind of margins. I mean, I always said it's great to find something that costs a penny and sells for $1 and is habit forming. This doesn't cost anything, and it's very useful. I mean, if you're looking up auto insurance on Geico, you've got an interest in auto insurance. I mean, it's a very directed way of talking to people.
Google Search is a money printer. In the latest fiscal quarter, the company generated over $54 billion in revenue from search. That was up 12.5% year over year. This is the largest part of Google's services segment, and while the exact percentage of search profit is not disclosed from the company, it's assumed that search is the overwhelming profit generator. Google Services had operating income of $32.8 billion in the latest quarter. As of today, that is the profit engine which creates the valuable company that is Alphabet. Since going public in 2004, Google stock has a total return of 6,856%. That is a compound annual growth rate of 22.91%. To visualize that, a $10,000 investment at that time would now be worth over $695,000. That's why Charlie Munger, Warren Buffett's longtime partner at Berkshire Hathaway, called this one of their biggest investment misses.
But I feel like a horse's ass for not identifying Google better. I think Warren feels the same way.
Yeah.
We screwed up.
He's saying we blew it.
Yeah. We can see in our own operations how well that Google advertising was working. And we just sat there sucking our thumbs.
But the question is whether Google is still a good investment in 2025. Will Google Search continue to be a cash cow for the company? The major risk is disruption coming from new technologies. For a while, this seemed quite unlikely. However, with the advancements in large language models and AI, there seems to be a real possibility. This technology risk has long been Warren Buffett's fundamental reason for avoiding the stock. This is a general principle that any long-term investor should be aware of.
It's not hard to see that Google is a phenomenal company. In tech, you get change. And the question is, who is the best at predicting change? And I'm not really very good at that. There are all kinds of people that would love to take away Google's business from them. They're going to have a tough time doing it. But I can't make a better prediction about whether that will happen.
So is now the time? Is Google Search about to be disrupted? If you spend a lot of time online in tech circles, you would think yes. You'd see new AI search engines like Perplexity and ChatGPT search coming out. And then more recently, you would see the launch of Grok 3, which is actually very impressive. It's pretty great. And if you spend time on X reading all the posts about people saying Google's dead, they only use Grok or they only use ChatGPT search, you would think that Google is already dead and declining. However, I think this is a drastic overrepresentation of what's happening. I think the death of Google has been greatly exaggerated. First off, Google Search just had record revenue and profits. In terms of money, it is growing year over year. Now, to be fair, the smart question to ask is really about usage and on a forward-looking basis. And there could be potential incremental risk, but it actually doesn't seem like usage is declining. There are anecdotal cases online, but Google just released their internal data saying they hit 5 trillion searches on Google annually, which is the first time they've updated that number in a long time. Also, the Google CEO in their latest earnings report said that in search, advances like AI overviews and circle to search are increasing user engagement. So let's not forget that Google is an AI company themselves. They have massive technical talent. In fact, you could argue technically they've been leaders in this space. They've been putting AI overviews into Google search. Plus, they just announced that they're releasing an entirely new AI mode, which is going to be another tab on Google search. And by the way, this is actually monetized with ads as well. Ads will show up in the results. So not only is Google leading in the AI search space, it actually seems like they have the best business model in the AI space. Google is adding more and more features into search, and it's becoming more useful doing things it couldn't previously do. And what do you know? Usage is actually increasing. And let's not forget, they have the largest distribution and the highest ability to monetize that usage. Let us also not forget that one of the top business use cases for machine learning and AI is in recommendation algorithms and advertising. Both Meta and Google have used machine learning to increase the return on investment for advertisers. Higher return on ad spend results in more ad spend. This is true in Google search and YouTube, and let's not forget that Google owns YouTube. So there is no doubt that the competitive landscape has gotten far more complex, and the risk of technology disruption is higher than ever, but there is no evidence yet that Google search is declining. It appears like the Google search cash cow is alive and well. And if you agree with that premise, then Google stock is currently trading at a pretty attractive valuation. The company is currently down 15% from their all-time high back in February. So today I'm going to explore whether Google stock is still a good investment in 2025 and beyond. I'll do a stock analysis going over all of their key financial metrics. I'll give analyst price targets, future earnings estimates, a valuation on the stock. Plus, I'll share my own personal portfolio and investment in Alphabet. So if that sounds interesting to you, stick around and let's jump into the analysis. My name is Zach, this is Dividend Data. You should leave a like and subscribe to the channel if you enjoy the video. Let's jump into the stock analysis. We have Alphabet, ticker symbol GOOGL or GOOG. Those are different classes of the shares. The current stock price is $173.86, and the company is valued at a market cap of $2.13 trillion. Oh, and by the way, if you want to use the tool I'm about to use throughout this analysis, all of this is available on dividenddata.com. That includes the stock analysis tool, my portfolio tracker, access to my portfolio, and an AI analyst where you can get analysis backed by verified financial documents. We currently have a March Madness sale where you can get 50% off the annual membership. And by the way, you can lock in that discount price for life, and this is the best price we ever offer. There's a 30-day money-back guarantee, so you can try it out with no risk. If that sounds interesting to you, click the link in the description and pinned comment to get 50% off the annual membership. The goal is to provide tools to help you in stock analysis and investing so that you can find better stocks. If dividenddata.com helps you find just one better company, then it more than pays for itself. I created it to help me, and I have no doubt that it's helped improve my investing. And I will show you why, because if we look at Google, these data visualizations help you see that the company is growing earnings per share consistently and just hit all-time highs. You can see that although the stock price has gone up a lot historically, this is all backed up by increases in earnings per share. And actually, the valuation is pretty compelling. Based on earnings per share over the trailing 12 months, the PE ratio is 21.6. That is not bad at all for a fast-growing company like Alphabet. For context, you have stocks like Coca-Cola, which are trading at a 29 PE ratio with far, far slower growth rates. This is why I like to look at data visualizations for these metrics, because you can instantly get a vibe for how the companies are growing over time. You can see that for Alphabet stock, analysts are projecting very high earnings growth over the coming years. That's 11% in 2025, 14.5% in 2026, 15% in 2027, 11% in 2028, and 23% in 2029. Now again, these are just estimates from analysts on Wall Street, and you shouldn't trust them 100%, but it will give you an idea about the expectation of future growth prospects. If they hit these metrics, in fiscal 2029, the company will have earnings per share of $16.28. Based on today's price, that will be a P ratio of 10.6. I'll tell you what, with a high quality big tech company growing fast, I think it's highly unlikely they'll be trading at a 10.6 P ratio. And even if they're trading at just a 21 P ratio, the stock price is going to be a lot higher in the future. Again, that is assuming they hit these earnings numbers. If we take a look at the company's revenue per share, it's growing at a 10-year compound annual growth rate of 19.14%. You can see that Q4 revenue just hit an all-time high, and annual revenue per share for fiscal 2024 grew at 15.54%. This is a highly profitable company. Gross margins are at 58%. Net margins are at 28.6%. Net income per share is growing at a 10-year compound annual growth rate of 22.63%. Free cash flow per share is growing at a 10-year compound annual growth rate of 21.35%. In my personal investing strategy, I view free cash flow as the number one financial metric to look at. And the reason why is that free cash flow is basically all of the money left over after they pay for everything. It's the money through which they can return capital to shareholders via share repurchases, dividends. It also allows them to make strategic acquisitions, although that's hard for a company as big as Alphabet because big tech is very scrutinized. Alphabet has a whole monopoly lawsuit going on, which is pretty interesting. And if we look at free cash flow, that is downstream of their cash from operations. You can think of that as all the cash the company generates after their basic expenses. In 2024, that was $125.3 billion for Alphabet. As you can see, their cash from operations is growing a ton. In fiscal 2015, that was $26 billion. However, one of the risks when we analyze this stock is that their capital expenditures are growing significantly. Just in the past year, that's gone up $20 billion. And if we ask the AI analyst on dividenddata.com, we can see that they're expecting future increases as well in capital expenditures. For fiscal 2025, they're expecting approximately $75 billion in CapEx. So again, we're getting another $30 billion jump. Now, Google has the business to support that, but this is still a risk. The question is what kind of return on investment they get. And if you're wondering where all this investment is going, it's all going into AI data center infrastructure. That is both for internal operations and for Google Cloud, their other business segment. But here you can see a graph of their capital expenditures over time and what a significant jump that is. And we're about to get another huge jump. Now, I personally think they're going to get solid return on investment from this because the bull case of AI is significant. And we already know in the worst case scenario, they're going to get machine learning advancements that will help increase the profitability of their search business and the profitability of their entire advertising business, including YouTube. And we also have the revenue increases in Google Cloud. But the bear case there is that they're kind of in a dilemma where if they don't invest in it, then they're putting all of their core businesses at risk. So they're kind of forced to be one of the biggest players. But guys, Google can handle it because they are wildly profitable. They also have a great balance sheet. As you can see, this company has been a cash cow for years now. Their assets continue growing and they just hit all-time high shareholder equity of $325 billion. They are spending a bit more recently though, and their cash and short-term investments is down to $65.6 billion. Oh no, it's down to $95 billion. This company is in a great position in terms of debt. They have negative $70 billion of net debt. They generate tons of free cash flow. However, they do have a non-cash expense when it comes to stock-based compensation, but this is not nearly as bad as some big tech companies and startups. As you can see, it's about 1/4 to 1/5 of their free cash flow. And this is important so that they can stay on the top of retaining great talent. The company is also repurchasing large amounts of shares. They just bought back 2% of their shares outstanding this past year. So they are returning capital to shareholders. In fact, they just declared a dividend for the first time, which, woohoo, this channel's Dividend Data. We focus a lot on dividend growth stocks. And this is definitely not a high yield company. The current yield's only 0.46%. But I do think this is poised to be a dividend growth stock of the future. And the reason why, to be a great dividend stock, you need to have a great business. And there is no doubt that Alphabet has a great business, and it's set to continue growing in the future. You also need to remember that although this yield is small, this dividend is a very small percentage of their earnings and free cash flow. The earnings per share payout ratio is 7.35%, and the free cash flow payout ratio is 10%. So there's tons of room to grow this over time, and it will actually increase a lot over time if they just increase it at the rate of earnings growth. So overall, I would say the fundamentals at Alphabet stock are very strong. But is it a good value to buy right now? I'm going to take a look at analyst price targets for Google stock, and then do a valuation via sum of the parts analysis, and I'll even take a look at discounted cash flow. And then finally, I'll give my takeaway and look at Google stock in my portfolio. So the current consensus price target on Wall Street for Google stock is $201.92. That implies that the stock is 16.14% undervalued. The lowest price target on Wall Street is $170, which is just below the current stock price. And the highest price target on Wall Street is $225. If we look at analyst grades, the consensus rating is buy, with 1 saying strong buy, 38 saying buy, 5 saying hold, and 0 saying sell or strong sell. Now I'm going to do a sum of the parts valuation, which is actually a pretty interesting technique where you break up all the different segments of a company's business. So in this case, it would be Google services, Google Cloud, and other bets. And then you take either the revenue or the operating income, and you assign a multiple to that segment. And then you add it all up to get to your valuation. So I wrote this prompt to feed to my AI analyst over on dividenddata.com. And it took the verified financial data for Alphabet stock and did this whole analysis to it. And by the way, you can just type a follow-up question if you want to change something in the results or do it slightly differently. And I'm going to do 2 different approaches here. I asked it to do price to sales and price to operating income. So first, let's look at their 3 business segments. You got Google Services, Google Cloud, and other bets. Google Services is the largest and most profitable by far. That includes Google Search, YouTube Ads, and their Google Ad Network. Then you have Google Cloud, which is the 3rd place cloud services provider behind Amazon Web Services and Microsoft Azure. That is also a fast-growing business, and they are just starting to become notable in terms of operating income for the company. And then you have other bets, which is kind of interesting. Alphabet has been funding this since they're wildly profitable, and they have a lot of different experimental businesses. Probably the most notable right now is Waymo, which is finally scaling up. But if I was doing a valuation on Alphabet, I would probably just barely include that segment. I would view other bets just as pure upside. I also asked it to give a range of multiples, so we have a lower and upper estimate. So for price to sales for Google services, it gave 6 to 8 multiple. That would value that segment at $1.8 trillion to $2.4 trillion. So on the upper end, you could argue that the company is undervalued based on that business alone. Then for Google Cloud, it gives an 8 to 10 multiple, valuing it at $345 billion to $430 billion. And then, as I mentioned, other bets not very significant. If you add all that up, it gives a range for a total valuation of Alphabet of $2.18 trillion to $2.88 trillion. So on the lower end, fair value, and on the higher end, about 20% or so upside. If we look at price to operating income, it has a 15 to 18 multiple on Google services, so 1.8 trillion to 2.18 trillion, 20 to 25 multiple on Google Cloud because that is growing faster. Although to be fair, the Google services business is much higher margin, so that's valuing Google Cloud at 122 billion to 150 billion. And again, other bets, it says it's nominal. So based on operating income, that puts it at a valuation of $1.94 trillion to $2.33 trillion. With a current market cap of $2.13 trillion, I would say that Alphabet stock is a great business trading at a fair valuation. It's not a screaming discount, but I would definitely not say that it's overvalued. I think it's priced fair, which is sometimes all you can ask for these great high-quality companies like Google. After all, one of my favorite Warren Buffett quotes is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." By the way, if you want to do a discount cash flow valuation for Alphabet stock, you can ask the AI analyst to do that. And if you scroll down, there's this whole calculator where you can fill in all these different metrics projecting future growth rates. So if you're interested, I suggest you try that out on dividenddata.com. And if you've been following me on social media, or if you're in our Discord community, you know that I share my buys. And Alphabet stock has been a company I've been buying during this decline over the past few weeks. It is now the 5th largest position in my dividend growth stock portfolio. This is a company I will continue buying as the stock price goes down. And to be honest, I'm trying to build it into a core position of this account for the future. And by the way, if you want to keep up with my portfolio live, you can go on dividenddata.com under Zach's research and click Zach's dividend portfolio, and you can get live access to my account and see my buys and dividends coming in. I think dividenddata.com is a great tool for the long-term investor. At least I tried to make it that way. It definitely helps me. If it helps you find just one better stock, then it way more than pays for itself. If you're interested, we do have a March Madness sale going on right now where you can get 50% off the annual membership and you can lock in that discount price for life. And again, there is a 30-day money-back guarantee, so no risk in trying it out. Just click the link in the description or pinned comment of this video. With that said, thank you for watching, and I'll see you in the next one.